Hello, everybody. Thank you for joining the Entrust Group's May webinar event, Growing Your Retirement Savings with Multifamily Real Estate, featuring Birgo. Before we get started, we do have a quick disclaimer. Entrust does not provide investment advice, tax advice, or legal advice. We are not CPAs, attorneys, or financial advisors. We do not recommend or endorse any investments, products, or services. The information in this presentation is for educational purposes only. We do, however, recommend that you seek investment, tax, and legal advice before entering into any investments. This is today's agenda. We'll quickly go over self-directed IRA basics, multifamily core concepts, state of the industry, why Birgo loves multifamily industry, direct purchasing, REITs, multifamily private equity, and at the end, we will have about 15-minute Q&A. We will also be providing both video and audio recordings of the webinar to everybody who has registered. A little bit about myself. I'm your host today. My name is Tony Uncle. I'm the Business Development Manager at the Entrust Group for the Northeast Territory. I've been with Entrust for over 3 years, and we spend our time educating investors and professionals on tax-preferred retirement accounts. I'd like to share a little background on the Entrust Group for those of you who are not already familiar with us. We are a self-directed IRA record keepers and custodians who specialize in holding alternative assets inside of retirement accounts for our clients. We have been doing this for nearly 40 years, have around 22,000 accounts, and roughly hold $3.6 billion in investor assets. One factor that makes Entrust unique is our single point of contact business model that we offer our partners and our clients when they open an account with us. We understand this area of business is much more complex, so we provide a higher level of customer service to our clients and partners. Most of our staff here at Entrust does hold the CISP designation, which is a Certified IRA Service Professional. We offer national continuing education classes for realtors and CPAs. We hold national and local events and webinars. If you're interested in learning more about this, please contact your local business development manager. And we sponsor an IRA Academy, where we actually teach the course that trains other people in our industry to pass the CISP exam. What is a self-directed IRA? Self-directed IRA is a retirement account in which the individual investor is in charge of making all investment decisions. A self-directed IRA provides the investor with greater opportunity for asset diversification outside of the traditional stocks, bonds, and mutual funds. For example, real estate, private tax liens, and notes can be purchased. All securities and investments are held in an account administered by a custodian or trustee. Some benefits of self-direction: you're in full control of your retirement assets. You are able to completely diversify your portfolio between alternative investing and traditional brokerage investing. And there are many tax benefits available to you. At this moment, we'd like to turn it over to our friends over at Birgo Capital, where they can take you an in-depth dive into the multifamily real estate market. Josh and Dan, the floor is yours.
Tony, thank you so much. We're really grateful to be here. As Tony mentioned, we're going to be sharing about investment real estate and your IRA, multifamily real estate in particular. Just a little bit of background on who we are. So Birgo Capital is a multifamily investment fund based in Pittsburgh, Pennsylvania. Got about 2,000 units of residential property under management, roughly 200 million in assets under management. And I'm going to hand things over to Dan Croce to give you a little bit of background on us as individuals.
Thank you, Josh. And thanks everyone for taking the time to share some of your Wednesday with us today. We're excited for the opportunity to share some of our knowledge and experience in the multifamily space, and we hope that you find it useful and productive. So as Josh mentioned, just brief introduction on us. My name is Dan Croce. I'm a co-founder of Birgo, so I've been with us since the beginning, and I have primarily overseeing our capital raising and general fund oversight. I've been involved with all of the transactions that we have purchased and sold over the years, and really intimately involved in all elements of the investment process for us. Birgo, as Josh mentioned, was founded in 2015, and Josh has been with us since our founding as well. He's my partner, and he's been involved in a variety of commercial real estate capacities, but in general, his expertise and his area of responsibility is in the acquisition process. So structuring deals, finding them, negotiating, closing. And he's been involved with all 200 million plus of our acquisition transaction volume since inception.
Thanks, Dan. So to go over some core concepts that we're going to discuss with our time together today. So first, multifamily. What we're referring to when we say multifamily is a building or complex designed for occupation by more than one family. So we're talking about apartment buildings. We're not talking about single family homes. Those can be a viable investment strategy for real estate investors, but we're talking about apartment buildings or complexes. We'll talk a little bit about workforce housing. This is housing that's affordable to households earning between 60 and 120% of area median income. So this is moderate income earners. This is typically not Class A properties, typically not Class C on the very low end of properties, kind of right in the middle, and usually not government subsidized, but naturally occurring affordable housing. Due diligence refers to the process that an investor goes through to validate the assumptions and expectations of their investment. In real estate in particular, this is examining and inspecting the physical property itself, as well as historical financials to validate your investment assumptions. And then, as Tony mentioned, we're going to talk about some different ways that investors can get exposure to real estate. Those being direct investments, which is you going out and buying a piece of property yourself, becoming a landlord. Private equity, which is an investment vehicle that buys assets, in this case, real assets, that are not publicly traded, usually structured as a private partnership. And then a REIT, which stands for Real Estate Investment Trust. This is a company that owns and generally operates income-producing real estate. We'll talk about a couple of different kinds of REITs and the distinction between those and other forms of real estate investment. So we're going to go into a poll here. I'm just curious to get a sense for where everyone is that's in attendance today. So other than your primary residence and any vacation homes, do you own investment real estate? So click all that apply. 1 would be I directly own real estate. 2, I've placed capital with other real estate investment managers. 3, I have publicly traded REITs in my portfolio. 4, I don't know or I'm unsure. Give you guys a few seconds to answer.
We have almost 60% in, just as a quick touch base, about 30 seconds in, about 70% voted now. Going up slowly, but I believe we have about the number we're going to get, Josh.
Great. Now, why don't we take a look at results? Oh, wow. So almost 70% of you directly own investment real estate. So we have a lot of real estate investors on this call. That's really helpful to know. We can move through that portion of the presentation a little bit more quickly. About a third have placed capital with other investment managers. Quarter have publicly traded REITs, and 1/5 unsure. Very interesting. Hopefully we'll all learn something as a result of what we're going to go through today.
Great, thanks, Josh. I am going to take a moment and give us a little bit of the lay of the land in terms of what's the state of the multifamily industry today, especially in light of all of the unique economic events of the past 15, 16 months. So the reality is it's good to be a landlord today, it's particularly a residential landlord. Vacancy rates are extremely low, and this is in large part a function of the fact that the single family home market is red hot. So I understand we have participants on the webinar today who are in all different geographies across the country, and I would venture a guess that regardless of where you are, the single family home market is probably extremely hot wherever you are. And so one of the trickle down factors of that is that vacancy rates are extremely low. Homes are more expensive, so would-be homeowners are forced to be longer term renters. And that also means that there's upward pressure on rents since there's so much demand for rent. This industry actually had remarkably strong performance through the COVID-19 pandemic. As Josh mentioned, we own about 2,000 apartment units. And in late March of last year, we were right there with everyone else, largely concerned about what would come of our portfolio given eviction bans and all kinds of challenges in the economy at large at that point in time. But the multifamily space did extremely well. Collections were very consistent across the country. You did see some pockets of softness in certain really large cities and urban cores, but outside of that, across the country, collections were great in multifamily throughout the pandemic. Capital for this asset class is still readily available and at historically low interest rates. Multifamily tends to be one of the places where borrowing costs are cheapest, and that is certainly true right now. The big players, Fannie Mae and Freddie Mac, have continued to provide great liquidity to this marketplace. Rents are keeping pace with inflation, and this is a hot button topic right now and will continue to be. But the most recent data that we're seeing looks like nationwide, we're seeing a lot of markets where year over year rents are up 7 or 8%, which is extremely high. So we are seeing upward pressure on rents, particularly as there's so much capital that's flooded the marketplace. Fundamental demand is growing. This is largely just a function of population, but we are in a population that is continuing to steadily move up and to the right. So that is a tailwind for demand in multifamily. And it's a haven of safety, particularly in light of some of the most recent events where, acceleration of work from home has been a challenge to office, or, government or economic shutdowns were leading to struggles for retailers and the growth of Amazon. It's really making multifamily to be viewed as the safest place to put capital, which also means it's very competitive to purchase right now. So why does Birgo love multifamily? We love it because it meets a basic human need. There's minimal downside because people prioritize their most important fundamental needs, of which stable housing is one. Our rent collections in our portfolio, much to our surprise, actually increased throughout the pandemic. And what we think we observed was that people really prioritize and place a particular emphasis on the stability of their housing situation. Again, we love that demand grows with the population, and the flip side of that is that it's supply constrained. This, as the saying goes, they ain't making any more land. The actual physical infrastructure for availability of multifamily properties is finite. So as there's growing population and finite supply, that is a tailwind for demand. Historical governmental support is another significant reason why we love multifamily. We did definitely see this throughout the pandemic, but because stable and affordable housing is generally viewed as a significant contributor to societal good, generally both sides of the political aisle come around to support stable and affordable multifamily housing. We also love the fact that it's a unique opportunity to leverage the capital of banks and large financial institutions. It generally has the best loan terms, lowest interest rates, longest amortizations of any asset class or any real estate asset class. We love the consistency. So, in contrast to office or retail or industrial, where if you have a tenant move out, it could take a year or 2 years to find a new tenant and your space goes dark and the cash flows are interrupted. That's not the case with multifamily. You have someone move out, and worst case, you need to spend a month redoing an apartment or a home. But generally, a couple of weeks, you can turn around an apartment and keep that cash flow coming again. So we love the consistency, and we love that there are multiple ways to generate return on investment. First, through current cash flow, because of the consistency of those monthly rent payments. The cash flow tends to be incredibly consistent. Mortgage paydown, there's a lot of capital that's available for multifamily loans, and they tend to have healthy margins on covering the debt service coverage on most multifamily deals. So you're able to pay that down and build equity over time. And then lastly, multifamily just has a great track record of over time increasing in value. So yeah, it's a generally safe bet that you'll be able to make some component of return from each of these three different elements of the return on investment.
So how do we invest in multifamily? Let's assume that you were very convinced by Dan's reasoning and you want some exposure. We're going to talk about 4 ways today. So first is direct investing. About 70% of you have said you own investment real estate in some capacity. So it's always an option to decide you want to be a landlord, you want to go out and buy property yourself. And we have private equity, which again, a private non-traded structure. We're going to talk about some specifics of what to look for in evaluating a private equity opportunity. Publicly traded REITs, which are, as it is stated here, publicly traded. You can buy and sell these on the stock market like any other security. And then an emerging structure we think is interesting for IRA investors being the public non-traded REIT, which we're going to talk about last. So direct investing, let's say you decide I want to be a landlord, I want to own more property or get into it for the first time. Kind of the first thing you need to do is pick where do you want to buy. You've heard real estate's about location, location, location. This is true. And what area you decide you want to invest in directly, largely dependent on risk reward preferences. We would say that it's your first deal in particular, or you're looking at something smaller, probably makes the most sense to buy something close to where you live, just from a practical standpoint. It's going to be easier to manage. You're going to know that market better and kind of know the ins and outs of the sub-market. You can keep yourself from getting into some trouble in an area that you don't understand. If you're open to doing larger deals, about 100 units and up is sort of the threshold that we found where it starts to make economic sense to look at some other geographical locations. You want to ask yourself the question whether you value stability and consistency as an investor, or whether you'd like to see higher growth and appreciation. So if you value growth, fundamentally you want to look for an area with a growing population base. The driver of growth and appreciation in multifamily assets is a growing population. So you want to look for areas that have new large employers moving into the market. Hubs of technology and innovation tend to be high growth markets, and you're really looking coastal hubs, growth markets. Sun Belt is kind of what we're seeing in the United States. So areas like San Francisco, Boston, Seattle, New York, Miami, these are areas that we're seeing grow and that would experience the investment characteristics of a growth market. So maybe less current cash flow, less stability over different real estate cycles, and more appreciation potential in the long term. If you value stability, what you want to look for here is a diversified economic base with stable employment drivers. So these are things that you're likely not going to experience huge asset appreciation over time, but you can buy assets that just sort of spit out cash and don't tank when the economy takes a downturn. So we look for things. This is where we play, by the way. Birgo is an investor that's more focused on stability and downside protection from a multifamily standpoint. So we like to be in areas that have significant meds and eds presences. So this is medical and education, financial services, significant government presence, industrial manufacturing. These are industries that don't get hit too hard during a downturn. And when you have all of them, you have a really robust local economy that's just sort of stable. Stagnant total population can be okay. You want to look at net migration. So the total gross population may be kind of the same, but there's a lot of people moving to that area. That's the case in Pittsburgh, where we're based. It's an older population. So stagnant total population is okay because we do have more people moving here, and that creates some unique opportunities. So what areas exhibit a stable kind of profile? You're looking at the Heartland, the Midwest, the Rust Belt. This is where real estate tends to be kind of safe, steady, downsides protected. It's predictable current cash flow versus huge appreciation potential. So the first thing you need to do after you pick a location is find a deal. 70% of you have done that successfully, so congrats to you guys. We would say this is one of the most difficult elements of getting direct exposure, is finding a high quality asset to purchase. If you're looking at a smaller deal as your first deal, so less than 10 units, you can work with a residential agent to set up a multifamily search. And you'll likely see some smaller deals trade through kind of residential agent buy-sell listing agreements. Larger deals, you're really looking to find who are the multifamily investment sales brokers in the market that I want to be in that are moving product, and you want to really, really invest in those key relationships. There is no easy solution here. It takes time to build these relationships. We spend a disproportionate amount of time and effort investing into key brokerage relationships to convince them that we are a good and reputable buyer that's going to execute, and it takes time to build those relationships and that reputation, and that's how you see the best deals. So let's say you've picked a geography, you found a deal, now you need to do a deal. So we use a deal screening checklist, and by the way, if you want ours, we will send you ours. My contact information is at the end of this. You can send me an email and I'll send you what we use. Just kind of a quick set of gut check questions that can help you determine, is this just a quick kill or do I want to dig in more? And you can adjust this based on your individual criteria. Then you're going to move through a legal process of negotiating the terms of the deal using a letter of intent and then an agreement of sale. You want to find a good real estate attorney to help you with that process from a contract standpoint. Then there's a process, like we mentioned, of due diligence and closing, where you have some period of time, usually 30 to 60 days, to really dig into the asset and validate the assumptions under which you put the property under contract. So we're typically going through 3 years of historical profit and loss statements to see, okay, did the property perform historically how we think that it did? And then we're going to do a really deep dive into inspecting the physical property itself. We're going to be inspecting something like 15 to 20% of the units, all of the common areas, the roofs, HVAC systems. We really want to make sure that we know what we're buying from a physical asset standpoint. And then typically 30 more days to close after that period, where you're kind of getting your loan finalized and getting ready to transfer ownership. So what are the risks and rewards of direct investing? From a risk standpoint, as you can see, there are a lot of moving parts, very time consuming to properly move through this process. You can have large unplanned capital expenditures if you're not careful. If you buy a property and you find out in the first 6 months, I need to replace the roof and all of the heating elements in the property, that's going to crush your return. And there are some things that you can really get into trouble if you don't know what to look for from a physical standpoint. Can encounter messy financials. We found even with large property owners, they often keep really poor records. So it takes some financial sleuthing to dig in and really understand what happened over the life of ownership and what can our projections reasonably be. Property management is something you need to figure out. Smaller deals you can manage yourself for a period of time, but that's work, that's a job. You're going to be taking tenant phone calls and coordinating maintenance. That can be a headache. And if you move to third-party property management, there are some incentive issues there. Nobody's going to manage a property like the property owner. And we found that it's really important to manage the property yourself. There's also some practical capital constraints. If you want to do larger deals, you may not have the capital to be able to do that if you're using solely your own capital. Rewards, obviously, you own the deal directly. You get to keep all the upside, all the cash flow is yours, all the appreciation is yours. You own 100% of the economics, and you have complete control over what deals you do. So another poll, after hearing what we just shared about direct investing, a lot of you already are, but are you more likely to want to own multifamily directly, less likely, or are you unsure at this point? We'll give you guys about 30 seconds to answer this question. Curious to hear your thoughts. Okay, we've got about 60% in. Keep it open for a few more seconds here. Tony, whenever you're ready.
Cool. We were about 40 seconds in, 73% responded. I think it's about time. I'll close it.
Sure. Okay, gotcha. So a little bit under half, more likely to want to own. Very interesting. Like I said, any questions about that process or how we think about these things, feel free to reach out to us directly. We'd be happy to talk to you guys about that. 20% less likely, interesting, and 33% of you are on the fence. Got it. That's really interesting results.
Great. Well, thanks, Josh. I will jump back in and give us an overview of our next class of multifamily real estate, and that is private equity real estate. So this generally refers to an investment that is with a sponsor or a professional manager, generally for a predetermined amount of time and usually in a particular niche strategy. This involves pulling together capital from different investors, generally accredited only in a private partnership or LLC. And it can refer to either an individual project or a grouping of various assets together. But that's sort of generally how we think of private equity, whereas direct investment, you yourself are going and purchasing real estate. Here you are partnering together, trusting one manager, and usually agreeing on a particular niche strategy. So some key considerations for this type of real estate investment. First and foremost, in our opinion, is the experience of the sponsor. So track record of success and ability to demonstrate a particular competency to execute on a business plan. It's interesting, these days, multifamily syndication is becoming increasingly popular. I think every other day now I see a new investment group that's popping up, and that can be a good thing. It's giving investors more access to this type of product, but I think it is crucial to evaluate the skills and experience of the manager, because this strategy is highly dependent on the execution of the manager. With private equity, you generally have a specific thesis, and so it's important to think about how you view the world, how you view risk and return, and whether a particular private equity opportunity is consistent with the way that you view the world, whether it's core, which is sort of the more low risk, lower target return type, all the way up to opportunistic, which can be more risky, swinging for the fences types of opportunities. It's just important to think about how you view the world and whether or not a particular opportunity is consistent with that. The other significant element to think through with private equity is the terms of the investment. So length, it can be anywhere from 2 to 3 years on the low end up to indefinite on the high end. The distribution plan, how am I going to get paid back? What frequency can I expect distributions? When are they going to start? All those things are important to consider with this type of investment because they can vary widely. And the fee structure, aligned incentives. Some structures really favor the sponsor, and oftentimes fees are not very transparent or disclosed up front, or they can be hidden in documents. So it's important to make sure, if you're going to consider this type of investment, pay special attention to this, because this industry, the private equity industry, has a bad reputation for wanting to try to hide some fees. We also think that co-investment is important, and what we mean by that is that the manager should have significant capital at risk in the project or in the group of projects that the private equity real estate opportunity is investing into. So some risks and rewards of this. Risks are the illiquidity. So generally they will have 5 to 10 year time horizons or even longer. But in general, these are going to be the most illiquid type of real estate investment. In some ways, potentially more liquid than direct investing, depending on what your plans are. But in any case, relatively illiquid. Business plan risk. So whatever it is that you decide or that the manager decides is going to be the strategy, they often have a pretty particular niche of what they're going after. And if you end up being wrong about that thesis, then these investments can go south pretty quickly. They can have a lack of diversification. Again, many of these would be a single project. You could invest in a development project that would be a single asset. And in that scenario, if something goes wrong with that one specific building or one specific geography that you've invested in, it can mean trouble for the investment. Again, this is highly dependent on the skill and execution of a sponsor, whereas with a REIT, you might be sort of more trusting the governance of a public company structure. These tend to be privately held and highly dependent on a few key principal individuals. Private equity can be prone to lack of visibility and transparency. This isn't always true, but it is more true in this space than in some others, where there's a lack of communication or real transparency with what's actually happening in the project or group of projects that you've invested in. Valuation can be subjective or unknown altogether. When you make an investment, say it's a 7-year investment, you might not know what that investment is worth as you move through the timeline. Various sponsors have various ways of reporting this or not reporting it, and so it's important to understand how sensitive am I to knowing what the value is of my investment as I move through the investment period. And private equity is also known for having generally high minimum investment amounts, whereas different alternatives, you might be able to get in the game a little bit with less capital. This tends to be one that has a higher barrier to entry. Rewards are the ability to get exposure to exactly what you want without many of the drawbacks of direct investing. So you don't have to worry about the management responsibilities. You don't have to figure out the nuances of executing a transaction. You just trust someone else. And if you really like the thesis, then you get to be hands off and have access to the exact type of strategy that you want. Again, the tailored investment strategies, from everything from ground up development to stabilized Class A to workforce housing, where we play, there can be all different investment strategies, and you can tailor your appetite to find the right opportunity for you. If you like a specific geography, you can generally look for a particular private equity real estate opportunity in that city or that group of cities. So you can cater to that. Structures, if aligned incentives are of particular importance to you, you can filter through a search to find investment structures that are aligned with what you care the most about. Or maybe you only want to be in something for 3 years, so you can find something that matches that. And the potential for pass-through depreciation, this is a tax benefit that is actually not applicable so much on this call, given that we're talking about the IRA context in which depreciation is less relevant. But in other investment contexts, the potential for pass-through depreciation is a material reward of this structure.
Great. So publicly traded REITs, like we mentioned, this stands for Real Estate Investment Trust. And as the name would suggest, this is a publicly traded security. So in order for a structure to be classified as a REIT, it has to pay out a minimum of 90% of its taxable income as a shareholder dividend on a yearly basis. So there's a significant amount of distribution coming out to investors every year, and it's got to have at least 100 investors to qualify as a REIT. This is highly liquid and correlated to the stock market. So again, you can buy and sell this through your Robinhood or whatever brokerage account you happen to have. This is a click of a button like any other security that you have. And because of that, tends to have high volatility, tracks with the rest of the broader market. Because people can get in and out whenever they want, you can see some swings in valuation with REITs. You have access to many different property types depending on what you're looking for here. There are multifamily focused REITs, single family, office, retail, hospitality. There's a wide menu of options. So some risks and rewards of publicly traded REITs. Risks, again, wild volatility due to liquid nature of the investment. At the beginning of COVID, we saw REITs all over the place, depending on the focus of the given asset class that the REIT was focused on. If it was a REIT that was really focused on office or hospitality, those things cratered pretty much immediately at the beginning of COVID. There are REITs that focus on niche asset classes like cell towers or data centers. Everybody's assuming that we're going to be moving to more virtual at the beginning of the pandemic, so these quick spike. There's wild volatility, again, just like any other publicly traded security. target returns generally lower than those of other real estate investment vehicles. I would say the lowest really of any option, because these tend to be really big companies that have to deploy big chunks of capital at once. When you're doing really large deals, that's a very efficient and competitive market, so returns tend to get squeezed. Publicly traded REITs typically only have exposure to Class A assets, so really the best of the best. This can be a benefit, but if you have a different risk return profile where you'd rather be in B or C, something that's got a little bit higher risk return profile, can be difficult to get that with a publicly traded REIT. And most public REITs tend to have a blended asset base at some level. So you can find REITs that are solely focused on multifamily, but typically they have exposure to other real estate asset types as well. And those are product types you may or may not want. The rewards tend to be correlated, again, because they're publicly traded. This is a liquid investment that can be bought and sold just like any other public security. And it's the easiest way to access real estate investments. This is the click of a button. You can research what REITs you like, what kind of product types do they invest in, and make decisions based on that, and buy and sell out of whatever brokerage account you use. Highly regulated, these are big companies. That generally reduces risk as well. There's a safety and numbers factor. Because it's a large company, they typically have a big and diversified portfolio, and there can be some favorable tax treatment.
Great. I'm going to pivot here and profile for you the last type of multifamily investment for today. And this is a bit of a different one. This is public non-traded REITs. And I wouldn't expect that many of you on the call are too familiar with this strategy, but we're seeing it pop up more and more. And we think there's something to like about this for IRA investors. So we thought it made sense to give you a bit of an overview of public non-traded REITs. So as I stated, they're not necessarily newer by definition, but we're seeing more of them now. They are increasingly popular, and we're seeing more and more sophisticated investors interested in these types of products. They have a similar governance requirements and similar risk and rewards to publicly traded REITs, but there are some key differentiators, and we'll get into those in a moment. Chief among them are that there are less volatility than publicly traded REITs. And the flip side to that is that there's also less liquidity. Interestingly, these are generally available to both accredited and unaccredited investors. So they tend to have a bit of a niche strategy, and they make these niche strategies available, usually at lower minimums. They do tend to have a minimum, but they can be significantly lower than private equity. And one of the factors for these is that they do file regular reports with the SEC as well. So what are some of the risks and rewards of public non-traded REITs? So first, less visibility and transparency than publicly traded REITs. So there's a bit of a spectrum here. So this, in comparison to publicly traded REITs, this would be a risk. In comparison to private equity, this would be a reward, in the sense that they have less transparency in reporting than publicly traded REITs, but more than private equity. In comparison to publicly traded REITs, they're also less liquid, and they can have steep early redemption penalties. This isn't always the case, but with these types of funds, we are tending to see penalties wherein, if you're in for less than a certain amount of time and you want to redeem your shares, you might do so at a significant discount. They do tend to have more niche specialized investment strategies. We think this is both a downside and an upside, in the sense that compared to a REIT, it can introduce a bit more risk, but it also can provide the opportunity to access a niche type of strategy that you might be looking for. This also does tend to have a bit higher reliance on manager competency than a REIT, whereas a REIT, you're trusting an executive team that can be swapped out. There are lots of CEOs of REITs that have that kind of experience. Here you tend to be relying on a bit of a smaller team, so somewhat similar to private equity. And in this industry, in the public non-traded REIT space, there tend to be a lot of high upfront fees that are charged as broker-dealer commissions. So if these, often they are disclosed, but many times they're in the fine print, and investors aren't aware that a significant portion of their capital might be going to an upfront fee with this particular strategy. So it's important for investors to be cognizant of how much of their capital is actually going to be put to work. What are some of the rewards of this type of strategy? So again, access to specialized niche strategies. So whereas public exchange traded REITs, tend to, by virtue of their size, have to invest very broadly in only Class A assets, these types of funds can typically target a little bit more niche, specialized strategies that cater to a particular risk-return profile. They do tend to generally target higher net returns than exchange-traded REITs, in large part because they can access more specialized niche strategies. In comparison to private equity, they have a relatively high bar for compliance and governance because they're registered with the SEC. So they'll need to file frequent reports, they'll need to be audited. There's just a higher bar for financial reporting and compliance relative to private equity because these are public vehicles. They do have really favorable tax treatment for tax-exempt investors such as IRAs, and we can't get into that on this call. We're not tax advisors, but we think this is a compelling reason for IRA investors to look at public non-traded REITs. Some of the downsides that exist in private equity are less pronounced for IRAs in these types of investments. They tend to have a low volatility, so you get some of the higher return than the publicly traded REITs, but without the volatility. They tend to also have more clear mark-to-market valuations, so at least generally on like something like a quarterly basis, you would know what the value is of your investment with reliability. And again, they're more liquid than private equity or direct investments. These tend to have some sort of redemption feature where after you've been invested in it for some portion of time, you can redeem without penalty. And we think that's a pretty attractive feature of this structure as well. So to recap, multifamily real estate, in our opinion, is a haven of safety, and it's a place to park capital that has generally historically produced really solid risk-adjusted returns. There are lots of different ways to get exposure to multifamily, everywhere from doing it yourself all the way to clicking a button and investing in a public REIT. And in between, there's private equity and public non-traded REITs, which have many different features depending on your preference for liquidity versus return, volatility, etc. So that is a summary of the different ways that you can access these products. So a quick poll here as we conclude: which of the investment strategies that we discussed seem like the best fit for you? Curious to get a sense for how you're reacting to some of the information that's been presented. So really interesting. I'm seeing the results trickle in, and it looks like there's a really good mix. We've got about half of you that have voted now, a little more than that. So we can go ahead and share results if the Entrust folks want to do that whenever they're ready. Yeah, so a third of you still believe that direct investment is the best way to go, and I think that that's a reasonable position. I agree with you personally. I still hold those. And then about a quarter of you are into private equity or public non-traded REITs, and 10% public REITs or unsure. Great. With that, I believe I will, so here's our contact information. This will be up for you as we go through a bit of Q&A here in a moment. So no need to scribble that down now, but I'm gonna hand it back over to Entrust, but we would be delighted to continue the dialogue with you feel free to drop us a line or to give us a call.
Thank you, Josh and Dan. Very informative. So how do you invest in multifamily with a self-directed IRA? First and foremost, you want to do your research on self-directed IRA custodians and identify which one meets your criteria, one that you're comfortable working with. Due diligence is a very important part of any type of investment. Once you've met the custodian that fits your criteria, open an account. Second step is fund your IRA. There's 3 ways to fund a self-directed IRA. One is via a transfer, moving cash from an existing IRA at a brokerage firm to a self-directed IRA. Second is a rollover. If you have an old company-sponsored retirement plan, such as a 401k or a defined benefit plan, and you're no longer at that job, you can do a rollover into your IRA, or you can make a cash contribution, and you must follow the IRS contribution limits. When your account is funded, you can identify your investment, complete your market research, do your due diligence, review all possible investment information, do your vetting, and do your due diligence even more, and then make the investment and maintain your investment. All expenses and income must flow in and out of your IRA. Coming up with Entrust, our next webinar will be on June the 16th, Self-Directed IRAs 101. Please register and join for an in-depth look on how self-directed IRAs work. If you would like more information from Dan and Josh, please complete our brief survey today. More information on self-directed IRAs, you can contact me directly, or you can visit our website, theentrustgroup.com, and visit our learning center, where we have a robust learning center, which is many, many interesting articles in there. And you can also follow us on social media for daily updates, either on Facebook, LinkedIn, or Twitter. At this moment, we'll go to time for questions. We have about 10 to 12 minutes for questions. If Dan and Josh want to put up their contact information so our audience can have it. With the Q&A, we cannot speak on any tax advice or any types of investment advice. If any of those questions do come across as that, I will kindly ask that you contact either Dan or Josh offline. First question we have are, what are your thoughts on condo hotels like the Hard Rock San Diego or World Quest Resort in Orlando? That would be for Dan and Josh, and this is borderline investment advice. So just to be safe, I would please ask the individual who asked this question, please contact Dan or Josh for their personal opinions. Next one is also for Dan and Josh. Can you please clarify how long one has to hold these non-traded REITs to avoid penalties or fees?
Sure. This is Dan. I can take that. It depends. It will be determined by the particular non-traded REIT. So each one of these provides their own offering terms, and I've seen everything from no penalty out of the gate to, it can be up to 5 years until you're able to redeem without penalty. So different public non-trade REITs have different redemption structures, and it just depends on the particular offering.
And I believe we've seen some burn-off structures where if you need liquidity faster than that allotted time, there's usually some kind of, you can redeem with a 10% discount to current net asset value or something like that.
Thank you, guys. Our next questions, which options are available through Birgo?
Yeah, this is Dan again. I can take that question. So the reality is today, none. So we have historically been a private equity real estate fund. So we have 2 funds that we have raised, and we're finishing up the deployment of our second fund. So today we do not have an open investment opportunity. We are going to be reopening ourselves to raising capital in the third quarter, and actually we are excited about pursuing this public non-traded REIT concept. We think it sort of offers the best of many worlds to investors. So that's what we're contemplating for our future. But today we do not have an open investment opportunity.
Thank you. Next one is for Birgo as well. And you will have to contact them directly, but the question is that they would like an idea of what a Birgo K1 looks like, depreciation pass-through, business income, investment income. Please contact the Birgo folks directly for that and see if they can provide that to you.
And we'd be happy to.
Next question, does a bank offer non-recourse loans through an IRA down payment? I can answer that. Yes, there are non-recourse loans available to IRA investors. If you go to our website, theentrustgroup.com, and search for non-recourse loans, we do have a whole section in the Learning Center dedicated to that, as well as providers. Does the IRA have to pay capital gains? Again, that's a tax question, and we can answer that through your CPA or your accountant. Can you use a self-directed IRA to fund the down payment and finance? Sorry, the question changed on me. Yes, you can use your self-directed IRA as a down payment, and then the financing will come through the non-recourse loan. Roth versus Rob's, pros and cons. That's something you need to talk to your advisor about. With Rob's transactions, you're taking, your old 401k plan and you're opening a C Corp and you're buying 100% of the stock to own that corporation. With a Roth IRA making investments, a little bit of different structure where you're just simply an investor. Definitely a question that you want to sit down with your advisor or your accountant and figure out which is the best one for you. Next one for Birgo. Are two separate SFH structures, single family home / structure on the same lot with two different addresses considered multifamily home? In the local jurisdiction, two on a lot regulates as multifamily home with respect to rent control. What do you think, guys?
Dan, do you have thoughts here? I'm honestly not sure.
I mean, yeah, I can tell you how I would think of it. I think, from a technical standpoint, it would depend on the municipality and the zoning in a specific geography. That would, I kind of think of it from a financing lens. That type of structure, anything 4 units and below, tends to be financed similarly and viewed in the industry as comparable to single family. So it's almost like a portfolio of single family. Whereas 5 units and above tends to be in the industry thought of as properly commercial, at which point it is sort of widely thought of as multifamily. But it depends, on the lens from which you're viewing it. If it's more from a zoning standpoint or more from sort of a capital market standpoint.
Thank you. Next question, is there a way to use the BRR investment strategy with Roth IRA? Yes, theoretically you can do that with the Roth IRA. For anybody that's not familiar with the BRR method, it's buy, rehab, rent, refinance, repeat. The only thing that I would bring up on that method is the refinance, and that you have to, if you're leveraging through, a non-recourse loan, you have to see if those loans can be refinanced. But you can definitely buy, rehab, flip, and then reinvest within a Roth IRA. Next one's for Birgo. What % do you have to evict?
Yeah, sure. I can take that. Very little. Evictions are a very small proportion of what happens within our portfolio. And it's actually, so we're a vertically integrated company. We do all of our own property management. We have a team of 65 people, and the majority of those are out in the field doing maintenance, leasing, and property management. And we believe that eviction, minimal eviction is owing to the fact that we're heavily relational. We have really low rents across our portfolio. The average rents are less than $700. So it's a very affordable, tends to be a lower income tenant profile. But even so, our evictions are very minimal. From a percentage standpoint, it really depends on the asset, but portfolio wide for us, with 2,000 units, we probably had, in the last, well, COVID's an interesting time because you can't really evict, but in normal times, we would probably have less than 50 evictions in a year. So that's, 2.5% or less.
Thank you. Okay, and the last one is for you guys as well. Are REITs offered for the over 55 communities? And then a lot of cranes in South Florida. Yes, South Florida is building like crazy, but REITs in 55 and older communities, yes.
I don't know of any in particular. My guess would be yes. I mean, the REIT structure is something that groups can elect if they think it makes sense for their particular strategy. I would imagine that there is something that focuses on 55 and older communities. Dan, do you have?
No,
have you seen any?
I would have said the same. I imagine that such a thing exists. I can't think of a name right now.
Yeah, wide menu of options. These are great questions. Thanks, everyone.
Next question will need to be taken offline as well. It's for Dan and Josh, and they're asking what your thoughts are on Section 8 housing. Please contact them directly. You can find their phone numbers and email addresses on the screen. Unfortunately, we cannot get into any type of investment advice, even if it's a thought or an opinion. Next one is for you guys as well. Always been told that duplexes are more expensive to build than 2 single-family homes of equivalent size. Your thoughts on that?
Yeah, interesting. So we don't spend a lot of time or thought on new builds. We're mostly focusing on acquiring existing product significantly below replacement cost. But we have done some construction, and I guess I would say that probably holds true. If we were building, we would be, I think, building single family, not investment advice, but to my intuition, I think building a single family makes more sense than building duplexes for a variety of reasons.
Thank you very much. And thank you guys for attending. We do have to end promptly now. We have our IRA Academy running concurrently, and we need to log back in for sessions. But thank you very much. Will be sent out to all attendees, and the webinar will be available tomorrow. For joining, to all the attendees, everybody have a nice rest of your week.